Hello, my name is Haag Sherman. I'm CEO and Chief Investment Officer of Tectonic Advisors. Today I was asked to talk a little bit about risk tolerance. What is your risk tolerance? How do you figure that out? Risk tolerance is how much can you stand the volatility of your investments day to day, month to month, and year to year. If you think about risk tolerance, a good way to think about it is how comfortable are you with a certain percentage loss in your portfolio in a given year. So think about U.S. equities. They've been an outstanding return over the past 50 years, but that's not without volatility. Think about 1999. In 1999, U.S. equities across the board gave you about a 50% return, give or take. That felt pretty good. Fast forward to 2008 and 9. You experienced about a 50% loss in your portfolio if you invested in U.S. equities. That didn't feel so good. So with those great highs, you also experience great lows. A lot of people can't stomach that type of volatility in their portfolio. So therefore, what you do is you develop investment strategies to address or reduce your volatility. Markowitz won the Nobel Prize through modern portfolio theory, which is a great free lunch of investing, which means if you add different asset classes, you have the ability to reduce overall volatility and give an investor a smoother return stream over time. Your risk tolerance also changes as you age. As you age and near retirement, you really can't withstand a profound loss in your portfolio. Therefore, your asset allocation, your investment strategy has to change as you near retirement and importantly, as you are in retirement, to give you more stability and the spending power that you need to live your lifestyle. So if I can close, I'd like to remind you of 2 or 3 things. Number 1 is risk tolerance is also often measured by volatility. What kind of volatility or up and down can you really withstand in your portfolio? Number 2 is that you can manage this volatility through asset allocation, which means you're not going to experience those great highs that you will with a concentrated portfolio in equity, but conversely, you're not also going to experience the lows that you do with an all equity portfolio. And again, that's done through asset allocation, modern portfolio theory that Markowitz won the Nobel Prize for. And number 3 is your risk tolerance changes over time. The risk that you can stand in your 20s will not be the same as you can stand in your 40s, 50s, and 60s, and particularly as you enter retirement and are retired.